Subscribe to LearnCab and hit the bell icon to get notified.
Welcome back, students. Now let us study about the different types of shares which a company can issue to the public. So we know that there are two main types of shares, right? We have equity shares and preference shares. So what are these preference shares? Of course, you have heard the name. But why are they called preference? What is the preference that they get? So they get preference with regards to two aspects. That is, one, payment of dividend, and another is payment of capital or repayment of capital. So these preference shares, they are not really the owners. Why? Because they are not really taking much of risk. Only the equity shares take a lot of risk. That is why these people, they do not get any voting rights. So a point to be noted here, preference shares, they don't get any voting rights. So usually the companies can prefer this type of financing when they feel it is cheaper than raising any loan or debt. Okay, so dividend in this case, in case of preference shares, is generally cumulative in nature and need not be paid every year in case of deficiency of profits. Meaning, if there is insufficient profit, they need not pay. However, it will accumulate year on year, and when there is sufficient profit, they will pay. Now, we will see that in detail. Another thing is that the Companies Act prohibits, means absolutely does not allow, the issue of any preference shares which is irredeemable. In other words, what does this mean? All preference shares are redeemable. All preference shares are redeemable. Of course, the time period may vary. Some may be redeemable soon, some may be redeemable later. Alright, now let us look at the different types of preference shares that we have. First thing that we just came across was cumulative preference shares. So the word cumulative itself tells you that in this case, something is accumulating. What is that? Nothing but dividend. So dividend is accumulating. Even if you are unable to pay your shareholders this year, then that particular amount which is payable to them will accumulate, and when you have sufficient profit, that is, when the company has sufficient profit, they will pay the dividend. So, in other words, this particular profit is payable even out of future profit. This particular dividend is payable even out of future profit. So, it accumulates unless it is paid in full, and that is why they are called cumulative preference shares. And these arrears means the dividend which you have not paid, the payable dividend, that will appear in your balance sheet as a contingent liability. Now, you all have studied what is contingent liability. What is that? It is a liability which may or may not occur depending on the happening or non-happening of one particular event. Now, in this case, what is the event? In this case, the event is profit. So, we don't know whether this will happen or not happen. So, if there is profit, if it happens, then you have to give the dividend. You have to give the dividend. If it does not happen, what will happen here? It will accumulate. In other words, we can say, and this is the case where cumulative comes into the picture. It accumulates. Alright, so that is why contingent liability. So if in case this particular dividend remains in arrears, means if it remains unpaid for a period of not less than 2 years, means 2 years. If it remains unpaid for 2 years or more than that, then the holders get a right to vote on every resolution in every matter in the general body meeting of shareholders. In the sense, up till now, who had the right to vote? Only the equity shareholders had the right to vote. But if the preference shareholders are not paid their arrears of dividend for 2 years, then they also get a right to vote. Then we have the next category, that is the non-cumulative preference shares. So as the name itself suggests, in this case, the dividend does not accumulate. So it just carries a right to fixed amount of dividend. The rate of dividend is fixed, but In case no dividend is declared because of lack of profit or because of loss, then this right to receive expires. It doesn't get carried forward. It doesn't accumulate. All right? They don't get any right in the future profit. Then we have something called the participating preference shares. Participating in what? Let us see. They get a right to participate in the surplus profits. Okay, in the surplus profits, if any, means if there is anything left after the equity shareholders have been paid dividend. Means this extra profit that is remaining after paying equity shares, then they get a right in this extra profit. That is the participating preference shares. So, similarly, we have something called non-participating. What else do they get a right to participate in if they were participating? They also get a right to receive predetermined portion of surplus at the time of winding up also, after the equity shareholders have been paid off. So, participating is in the case of dividend, surplus profit left after paying the equity shares their dividend, and also in the case of winding up if there is anything left after paying the equity shareholders. Basically, any excess left after paying off equity shareholders. Non-participating means, as the name itself suggests, this particular right of getting surplus is not there. That's all. So, there is no accompanying additional right in profit. There is just fixed rate of dividend. Then we have redeemable preference shares. Now, you all know in general context, all shares, all preference shares are redeemable. You cannot really issue irredeemable preference shares. So, redeemable, what does it mean? They can be redeemed, or you can get the cash, you can get the money back, whatever you have invested, after a certain number of years. Now, that number of years will be decided beforehand itself. Now, what is this non-redeemable? I already told you all, they cannot issue irredeemable preference shares. What is this non-redeemable? So, they don't carry with them an arrangement regarding redemption. Means there is no specific arrangement of redemption. However, they cannot, no company can issue irredeemable preference shares or shares redeemable after expiry of 20 years. Means what? Up till maximum 20 years only. After that, you have to redeem these preference shares. Only up to 20 years you can actually allot these shares for a period of only 20 years maximum. More than that you cannot. You have to redeem them. So what is this non-redeemable? Nothing but a specific arrangement is not given. Does not mean you don't pay them back. You have to pay them back after 20 years. However, in certain types of companies which are involved in infrastructure projects, for them the redemption period is more than 20 years. They have been given a set of 30 years or so by the Companies Act. For them it is extra. For them this particular 20 years does not apply. But otherwise you have to redeem them after 20 years. Maximum after 20 years. Now the next kind, it is convertible preference shares. So as the name itself suggests, they have a right to convert. Convert into what? Obviously convert into equity shares. They will not convert into any other option. For them the most beneficial would be converting into equity shares, right? So why would they do this? If in case they feel the company is doing very, very well and their fixed rate of dividend is very low and equity shareholders are making a lot of profits, then they would definitely want to convert, right? So in such a case, they may opt for convertible preference shares. So they have an option to convert. Non-convertible, quite the opposite. They don't have an option to convert. They don't have any option to convert from preference to equity. Now, the next main category of shares is the equity shares. You all have understood preference shares so far. What is this equity shares? So, from what you all understood, you all can make out that preference shares don't really take much risk, right? They have a fixed rate of dividend. They get preference when it comes to repayment of capital also. So, they are safe investors. Whereas the real owners, just like how you all understood in sole proprietorship, the real owners of any business are the ones who take the risk, right? And that is why these equity shares or equity shareholders are the real owners over here. They don't have any preferential rights. They don't have with regards to safety, with regards to dividend or repayment of capital. But if the company does very well, they definitely have an option of getting very high dividend. They have a share in the profits, they have a share in the reserves. It is all theirs, right? They are the owners. So now the rate of dividend, how is this decided? It could be recommended year on year by the board of directors, and they will have, of course, equity shareholders, because they are owners, they will have a right to vote. So these major decisions of the company will be in their hands because they have a right to vote, right? And they carry voting rights. These shares can be issued by the company either for cash, means for money, or for consideration other than cash. It could be in the form of assets. So the shares need not always be issued for money. It can be in the form of other assets also. Now, how is this issue actually done? Now, we learned a little earlier also about private company, public company, and we understood that private company, why is it called private? Because it is not open to public for investment. So that is why a private company will generally issue its shares by private placement. Private placement means what? Basically, they decide beforehand whom they want as shareholders, and they invite only those specific people to become shareholders. Now, what about public company? This is open to public. So the public has to get information about the company, right? So the company has to invite the public to come and buy its shares. How will it invite? It will invite through a prospectus. So this prospectus will contain a lot of information about the number of shares, the price, about the company, its goals, objectives, this, that. It's like a small invitation which contains whatever is there about introduction about the company and about an invitation to buy the shares. That is a prospectus. Now, after that, once it gives the prospectus, it has to ensure that people buy, right, the shares. Usually, the share price may be divided into certain number of installments. So, in order to get the share, you will have to first apply. So, while applying, what do? You pay an application money. This application money will be decided by the company. Just like how when you want a seat in a college, you have to apply first, right? And then once it is confirmed, they will then allot the seat to you. Similarly, in this case also, when it comes to companies, you have to first apply. This application money has to be at least 5% of the nominal value. Nominal value is nothing but face value. In the sense that, let us say the cost, or let us say the face value of the share is 100 rupees. Then application money, that is the application part of this entire amount of 100 rupees has to be minimum 5%, means at least 5 rupees. It has to be. Usually it's more than that, but it has to be at least 5 rupees. Then once this application money is received, minimum subscription is received, then it will allot the shares in consultation with SEBI. Whatever rules and regulations are there, according to that it will be allotted. So what is this allotment? Like I told you all, once you all apply for a seat in a college, then it has to be approved by them. They will look at your documents, your marks, your progress in the past, and they will decide whether the seat has to be given to you, right? And then it is allotted. How is it allotted? There will be so many students applying, right? They cannot give you more seats than what is actually there. If they have only 100 seats, they cannot allot 200, right? They can allot only 100. Now they have to decide, they have to choose whom to allot, whom to reject, all of that. Same thing happens in the case of a company also. So this allotment is nothing but an appropriation of certain number of shares to an applicant. So if there are totally 1000 shares which have been offered to the public, definitely they can allot only 1000 shares. They cannot allot 2000 shares. Similarly, if they have offered 10,000, they cannot allot 12,000 shares, right? So only up how much they have offered to the public, that much they can allot. So they will have to decide if in case there is oversubscription, means too many people have applied for the shares, they cannot allot all these shares. So they will decide, but this can happen only if minimum subscription has been subscribed. Now what is this minimum subscription? It is 90% of the issued amount. meaning to say at least 90% of the entire issued amount has to be subscribed. If it is not, they cannot go ahead with the allotment procedure. All right. Now, what are the different types of installments that can be there in the case of issue of shares? Different types of installments. So, you can have several types. First one is the application money. Now, let us say the price of the share is 100. Application money might be 10. Allotment money, second installment, at the time of allotting the share, this could be 20. Then first call money, this could be 30. Second call money, this could be another 30. So you have 60, you have 80, you have 90. Final call money, you could have another 10. So that makes it 100. Now this need not be the case always. It might be only application, allotment and call money. These two may not be there. It depends from company to company how many installments they want to raise the capital in. All right. So accordingly, they will decide how many installments. Okay. Now, issue of shares for what? It could be, like I told you all earlier, for cash, or it could be for consideration other than cash. Now, when you're allotting it for cash or even for consideration other than cash, you can be allotting it in three different ways. Either at par, means what? Face value is equal to your issue price. Face value of share is 10 and you're issuing also at 10. Then it is at par. At premium. So here, face value is a smaller amount, but your issue price, I'll call it IP, is a greater amount. Means face value might be 10, but your issue price is 15. 5 rupees is premium. You are issuing at a higher price than the actual price. Then you can have sweat equity shares. Purposely, I have not written at a discount because actually you cannot issue shares at a discount. It is prohibited. Or except in the case of sweat equity shares. So sweat equity means what? It is given to the employees of your company. Could be to directors, could be to other employees, managers, etc. For their services or because they have achieved certain targets or to reward them, you may give them sweat equity shares. So these are usually at a discount. Meaning to say they are much lesser than what is actual market price or what is the issue price. It could be much lesser than that. Since you're giving it to your own employees, it can be given at a discount. Otherwise, you are not allowed to issue shares at a discount. Then consideration other than cash. Here also it could be either at par, premium. All right. Now this is usually given to whom? It could be to vendors of assets, maybe for exchange of assets, etc. Or it could also be to promoters because they have, rendered some services to you. So in exchange for those services, you're going to allot them shares. Okay, so it's not necessary that the shares are always given for cash. It could be even for exchange of assets or in return for some services. Now, what is full subscription? So whatever shares you've offered to the public, if they are entirely subscribed, means the entire whatever you've offered is taken up by the public, then it is called full subscription. So for now, let us deal with a problem or two on the basis of an assumption that these are achieved as per full subscription. Okay. So let us look at question number 2. A company invited application for 10,000 equity shares of 50 each, payable on application rupees 15, on allotment rupees 20, and first and final call, means there's only one call here, rupees 15. So 20 plus 15 plus 15 is equal to 50. Now applications were received for 10,000 shares. How much you had offered? 10,000 shares. And now you're receiving it also for 10,000 shares, means this is full subscription. And all the applicants are allotted the number of shares they have applied for, and installment money was duly received. So there is no call scenario here, there is no rejection here, nothing. They have applied for the same number of shares that you have offered. So now you have to pass journal entries according to this. So we will go to our working. We have drawn a format of journal entries. Particulars is there, debit column, credit column. Let us start. Our first entry. What will our first entry be? For receiving the application money. Now for receiving application money, what is the entry? Money is coming in, right? So bank account debit to equity share application account. Remember students, this first entry is always like this when it comes to issue. Bank account is debited because money is coming in. Equity share application account because you're going to keep your application money in this particular application account, okay, and up until you transfer them to share capital. So the first entry is always going to be this way. Now, what is the amount? You had 10,000 shares, payable on application was 15 rupees. So 10,000 into 15. Being application money received in respect of 10,000 shares. Now we go to the second entry. What do we do after we receive this money? We will transfer this to the share capital account. Now naturally, share capital account has what balance? Credit balance. So share capital account has to be credited. What will you debit? You're transferring from equity share application. So equity share application has to be debited. So equity share application account debit with 1,50,000 to equity share capital account. Being application money transferred to equity share capital. All right. Now let us look at the question. They said 20 rupees is to be paid on allotment. So now that you have already transferred it to share capital, you know that some money is due on allotment. So your next entry is going to be for allotment money due. Now what is the entry for allotment money due? That means share allotment account has to be debited and share capital account has to be credited. Why? Ultimately this is going to form a part of your capital and this is due, so debit will go to allotment account. So equity share allotment account debit to equity share capital 20 rupees. So 10,000 into 20 2 lakh. Being equity share allotment money due on 10,000 shares. Then they have said that all the installment money was duly received. So that means equity share allotment money was also duly received for all the shares. So when you're receiving allotment money, what is the entry? Bank account debit because money is coming in. So bank account debit to, now what will you credit? While passing the due entry, you debited equity share allotment. Now when they are paying, you have to credit it. So equity share allotment. ₹2 lakh. Being equity share allotment money duly received. Now, we have another amount, ₹15, which is to be collected or which is to be received at final call. So our next entry is going to be final call due. So when final call is due, what is the entry? What should be debited? Equity share final call account. So equity share final call account debit to which account are you going to credit now? Because this money has to ultimately form part of your capital, you will credit equity share capital. So to equity share capital account. Amount was 15 rupees. So 10,000 into 15 rupees, 1,50,000. Being final call money due on 10,000 shares. Now your final entry. What's going to happen now? Again, they have said installment money was duly received. So you're going to receive final call money on all these shares. So when you receive, what is the entry? Money is coming in. So bank account debit to what will you credit now? When it was due, you debited final call. Now you will credit that. So to equity share final call account, being final call money duly received on 10,000 shares. With this, you completed the journal entries with regards to issue of shares when it is full subscription. So first entry was for receiving application money, bank to equity share application. Then for transferring it to share capital, equity share application to equity share capital. The next entry was for allotment money due. So allotment account debit to equity share capital. Then for receiving it, bank account debit to equity share allotment. We, in other words, cancelled the equity share allotment because we don't more need it. We have already received that money and we have transferred to equity share capital also, right? Then equity share final call due to equity share capital. We increase the share capital balance and then we receive the money. So bank to equity share final call. We had to cancel the final call account. In other words, we don't want it anymore, right? It's no more due. It's already paid. So with this, we received the money and we duly transferred the money to equity share capital account on this particular problem. So I hope you all have understood this question, students. Thank you.
Subscribe to LearnCab and hit the bell icon to get notified.